December 2004 was my first Christmas in Asia. My family and I had arrived in Hong Kong in late May. ING, my home for the previous decade, had withdrawn from the convertible bond market, seemingly finding the sale of the CB business too complicated as part of a package deal of selling its Asian business to the Australian investment bank Macquarie. As Asia emerged out of the shadow of the SARS epidemic, I realised that there was an opportunity to take advantage of a market many people had chosen to leave. I managed to secure the role of building out Lehman Brothers' customer-facing convertible bond business in Asia. Until that time, Lehman Brothers had only operated a highly profitable proprietary business out of Tokyo. Proprietary trading, or prop, is trading with the bank's money for profit or indeed loss if you aren't too good at it. One of the outcomes of the global financial crisis, which occurred later in 2008, was that banks were forbidden from prop trading, and effectively prop was regulated out of the banks. The rule covering this in the US was the Volcker Rule, introduced as part of the Dodd-Frank Act. In my naivety, I had no idea that winters really existed in Hong Kong, so around late November, when the temperature suddenly dropped, we scrambled to find warmer clothing in the shops of Tung Chung. It was winter too in the convertible bond market. One of the largest players in the market for convertible bond arbitrage, GLG Partners, lit the catalyst for a depressed sector that faced lackluster returns. GLG was so large that when they made the decision to sell, the entire market was impacted, and in 2004 into 2005, GLG sold, day after day, position after position. The feature of the market in 2004 was a collapse in volatility. Convertible arbitrages price convertible bonds on where they assess implied volatility to be, and whether gamma trading, i.e. hedging the position with a short sale of shares in the company the CB is convertible into, and then adjusting that hedge periodically, can generate trading profits. Simply put, the more the shares in the company move, the volatility, the greater the opportunities are for adjusting the hedge and extracting trading profits, or trading the gamma. You might hear the term hedge ratio, which is known as the delta. Another way of thinking of delta is the chance of what you own, option or in this case convertible bond, being in the money and exercisable or convertible. The rate of change of delta is known as the gamma. They're linked. In 2004, gamma got crushed. But it wasn't just GLG selling that crushed gamma. An innovation in another segment of the market, capital guaranteed notes sold to retail investors, resulted in the banks that were the sellers of these notes taking in volatility in exchange. After a time, too much of this volatility byproduct meant that the banks became traders and indeed owners of volatility. With a mass market of gamma traders, shares had nowhere to move. Try to envisage a situation of orders queued up to buy on a fall and queued up to sell on a rise. I can get much more technical on this talking to you about long Vega positions. That means owning volatility and how to hedge Vega. But we're plain talking Skadi, here to simplify the technical parts of finance rather than make it more mysterious and inaccessible. We started this episode talking about December 2004. And on the 26th, catastrophe struck. A 9.1 magnitude earthquake off the coast of Sumatra, Indonesia, triggered a tsunami which devastated low-lying communities in Indonesia, India, Sri Lanka, Thailand and others, resulted in over 200,000 people losing their lives. In the days after the tragedy, I recall the temperature dropping further in Hong Kong. It was so cold. Despite this tragedy, and intuitively the uncertainty an event on this scale should cause, volatility remained sharply unchanged. Looking back, the VIX index, which is the Chicago Board Options Exchange Volatility Index, declined through 2004 from a 15 to 20% range. A quick trick for sounding like an experienced derivatives hand is that 16% means you expect a daily movement of 1%. Volatility is additive, so 32% vol would be a 2% daily movement. That's a quick trick. Well, in mid-July 2005, the VIX went as low as 10%. Just on a per-movement basis, this meant stocks were less risky to hold than US Treasuries, as I recall. Crazy stuff. But hey, a few years ago, oil prices went negative, and just look at the oil price today. Indeed, all sorts of crazy things happen in the market if you watch for long enough. For convertible bond arbitrage hedge fund managers, this was a truly tough time. However, there was a portion of the market which was exceedingly lucrative, the market for privates. Private convertible bond financing, a niche segment of private debt financing. So it was that in February 2005, I encountered privates for the first time. It started around lunchtime as London began to get in. I'm telling you the story this way so you can get a feel for a bit of culture, a sense for the typical tensions that arise and are indeed part and parcel of being part of a global markets franchise. It's not uncommon, despite all the access to market feeds, broker lines, Bloomberg, Reuters and so on, that you're late to the party on information. And so it was then that it transpired that Lehman Brothers in Tokyo had issued an MSCB for a Japanese company called Livedoor. An MSCB is a moving strike convertible bond, and the market, in this case the convertible bond customers of Lehman Brothers' flow business, was smarting. In a market which had seen sustained volatility pressure and minimal opportunities to make money, Lehman Brothers in Tokyo had managed to privately agree to provide financing to Livedoor to the tune of around 80 billion Japanese yen. That was about $750 million at the time. Further, Livedoor had agreed as part of the deal to lend Lehman Brothers Tokyo its shares with which to hedge the deal. This removed one of the great uncertainties in any transaction that needs hedging. Will I be able to source the shares I don't own so that I can short sell to hedge? And another uncertainty, how much will it cost me? Forget about gamma trading with a moving strike convertible bond. The arrangements can differ, but effectively in a moving strike convertible bond, the conversion price deciding on what level the bonds can be convertible into shares is adjusted by looking back at an average traded price of the shares. The holder of the bonds really can't lose. They can aggressively sell the shares, and then the conversion price is moved down as a result of the recent lower share price, and effectively each conversion is profitable. As far as I can see looking back now, Lehman Brothers were given shares at about a 10% discount to the prevailing price on each conversion. But if you've already been selling shares for a few days ahead of the conversion, then your effective sale price is higher than the prevailing price would be on the day you do your conversion. International Financing Review reported that Lehman Brothers made around $140 million from the Livedoor MSCB. That assessment includes fees on the deal as well as traded profit. High fives, but realize something. All that profit came at the cost of a sustained decline of Livedoor's stock price. The shareholders of Livedoor, and it was a stock favoured by retail investors, suffered large losses. On that day in February 2005, when the phone started ringing, the convertible bond fraternity, and a few others besides, by the way, already could see the glaring potential for easy money. It was the sales team that bore the brunt of the customer reaction. In these situations, there is a chain reaction of outrage, from the portfolio managers to the dealers to the salespeople to the capital markets team. But in this case, it all fell on deaf ears. With a private deal, there often isn't a capital markets team to be involved. The deal is originated off the trading desk, and sitting on a large P&L, traders are unassailable. As a trader myself, I was watching events largely from the sidelines. I didn't have direct customer interaction, so wasn't exposed to the vitriolics my colleagues were. There was a risk to me, though, particularly if someone decided to do something reckless, like guarantee an allocation to a customer of bonds they didn't have, and the pressure on the sales force to deliver an allocation was extremely great. In situations such as these, which happen in markets businesses from time to time, it's all about leverage. I'm not talking about the capital pledged to prime brokerage, which can then be multiplied up for investment. I mean the ability to get what you need from a situation by the strings you can pull, the pressure you can apply. At some point, commercialism does enter the conversation if a customer is lucrative enough. they can become important enough and someone senior somewhere might bend. These situations occur on a regular basis in firms. It goes with the territory. Livedoor issued the MSCB as they were attempting a hostile takeover of another Japanese company, Fuji Television. By April 2005, though, the two companies had agreed to form an alliance averting the hostile takeover. However, the episode rocked Japanese capital markets. I was well aware myself that Japan is a market where certain unwritten etiquettes existed. When Barings collapsed in 1995, overnight the British trailblazing bank, which had cracked the Japanese market, was shut out in disgrace, most Japanese firms ceasing to do business with it, or with the company that rescued it, ING. Later, trading Japanese convertible bonds, I learned that valuing issuers' calls was a waste of time, as a Japanese firm calling a bond was unthinkable. Despite this, convertible bonds continued to be issued possessing issuers' calls. So it was that a hostile takeover in Japan was so unpalatable that Lehman Brothers business was impacted. And later, when the mercurial founder of Livedoor, Takafumie Horie, made a bid for government, the establishment turned. A fraud investigation ensued, and it transpired that Livedoor was an Enron-style fraud, using dummy partnerships to inflate revenues and operating profits. Horie was found guilty of fraud and sentenced to 2.5 years in jail. A light sentence really, considering the scale of the fraud, and that the scandal cost the life of a 38-year-old banker named Hideaki Noguchi, who took his own life as the investigation in Livedoor started. He was a vice president of HS Securities, a firm with close links to Livedoor. There are aspects to privates that need bearing in mind. Since disclosure is reduced, there is inevitably an element of opacity to privates. This attracts legitimate users. Using the proceeds from a private is common enough in takeovers. I finance them myself, as there's no need to disclose to the lender what the proceeds are for, and therefore reduce risk of tipping off the market of the takeover you may be about to launch. The opacity, though, also lends itself to fraud and manipulation. There is little or no aftermarket for securities, and thus reduced transparency on what securities may be worth. There is also potential for carouseling valuations, with small transactions ascribing a wider look-through valuation to the whole. It should be apparent too from the Livedoor story that there is potential for raised reputational risk and considerations for treating customers fairly when considering private finance. We hope to return to these aspects in future episodes when we talk further about privates and how auditors, investigators, compliance and litigators should think about them. Till next time on the Skadi podcast.